Welcome back, doctors. How confident are you actually feeling about your taxes, particularly in 2026? So today we have a very, very special guest, my dear friend Vivian Lee. She's a CPA. She started PIP Tax in Dallas, and she works with a lot of doctors, and she's going to be giving us the inside scoop on taxes for doctors. So once again, welcome back to more Money Minutes for Doctors. I'm your host, Katherine Vessenes. I'm also the CEO and founder of MD Financial Advisors. So before we get started, listeners, if you've got any further questions or there's something you want us to cover in a future episode, please reach out to us. You can do that at info@mdfinancialadvisors.com. If you have some questions for Vivian, we'll give you her contact information at the end so you can reach out to her. And I consider it a personal favor if you don't forget to like, subscribe, and follow us on social media at MD Financial Advisors. All right. So tell us, Vivian, a little bit about your background.
Yes. Well, thank you, Catherine. Thank you so much for sharing your platform and allowing me to share my perspective on taxes and the current developments. As we all know, the OAAA, Triple BA, which hear me refer a lot in our session. I'm Vivian Lee. I am the CPA and founder of PIP Tax and Consulting here in Dallas, Texas. I've spent nearly 20 years in tax accounting with experiences across national, regional, and boutique firms. And I built my firm around three pillars: the personalized, innovative, and proactive, hence the PIP in my name. Because busy physicians and dentists don't really have time for tax surprises.
Right.
I'm an SMU alumni. I started my career in financial services at a top national firm here in Dallas, Texas. Over the years, my background across accounting, real estate, financial services has really shaped a more holistic approach. So we're not just filing returns, we're aligning entity structure, cash flow, retirement planning, and tax strategies. And I love working with financial advisors like yourself so that way we can collaborate and provide the best client service to our physicians and dentists. So today I focus and specialize in working with healthcare professionals, especially practice owners, helping you keep more of what you earn and stay focused on patient care. So Catherine, just a quick note before we begin. This podcast is for general education purpose only. It's not individualized tax advice. So as always, please discuss with your tax advisor on, how this can apply to your specific situation.
Well, I love that disclaimer because we have to give a lot of them from our friends at the SEC require a lot of disclaimers, and that's one of the things that's going to be at the end of the podcast. So thanks for saying that. You mentioned the BB, you said BBA, but I think you mean the big beautiful bill, right? That passed
Yes.
last year that went into.
Yeah.
We're gonna get to that because there's some definite pieces there for doctors. All right, well, let's get started. What do you see as the common tax problems doctors make?
So most of the ones that I will be mentioning here aren't really, big tax tricks, but they're more like small compliance details that can really cost big money if you ignore them. So the number one is misclassification of employment status. Doctors often work in arrangements where they receive both W-2 wages and also 1099 income as independent contractors. So misclassifying income or misunderstanding the nature of the relationship can really lead to incorrect tax and reporting. Um, you know, Oftentimes doctors with income from consulting, speaking, digital health platforms, or product endorsements, they must carefully, report those income, which may be subject to self-employment tax in addition to their W-2
Right.
wages, and keeping track of, certain business deductions. Um,
Yeah, let me
so,
make a comment about that if I may. We have a
sure,
lot
sure.
of doctors in that situation who've got 1099 income. And a common problem I see is they don't realize that they have not had any taxes withheld from this income. And so I can think of one emergency med doctor we had. She was moonlighting and it was a lovely year. I don't know if she made $90,000 or something in this moonlighting job. And lo and behold, she had a $30,000 tax bill which was roughly a third of her 1099 income, that she hadn't escrowed for taxes. So this is such a big problem with the doctors with 1099 that one of the things we recommend that they do is they set aside a separate, I'm going to call it a tax account using air quotes here. And that money is not yours. It really belongs to Uncle Sam. And you might as well set it aside now so it's there on April 15th. Awesome. You had some other common tax problems that you wanted to cover.
Yes, and the next few items relate to doctors who have their own practice and has an S corp as their entity structure. So the first one that is a hot IRS red flag is owners who are actively working in their practice and not paying themselves a salary or paying something unrealistically low and taking the rest as distributions. So that's just one thing that we just need to be extra careful. That's a big hot IRS
Yeah, let's
scrutiny.
talk about that because it's very typical that they might come up to the Social Security limit, which you'll have to tell me what it is. I don't remember what it is this year. 180,000,
80,
190,000.
yeah, 182 or three. They change it every year, but in that same ballpark.
So typically they take a salary from the practice of about 182,000. That gets them the maximum Social Security benefit, which is very, very helpful. And the amount over that they take as a quote distribution, which there'd be less taxes on it, meaning they didn't have to pay the FICA tax on the amount over that. But you said you're seeing some problems with the IRS coming down on this.
Yeah, I mean, we've had doctors who pay themselves 50,000 or $60,000, which is, I mean, in my opinion, that's unrealistic because if they went out and, has an associate working for the hospital, there's no way that they're making 50 unless they're in residency, right?
Right, of course.
Yeah, so I just think, that's a professional judgment right there, that you need to, pay yourself a reasonable salary. And
And
so,
work with
you
your accountant on this because if you
yes,
can,
exactly.
I know that my accountant recommends going up to the maximum Social Security limit and then taking the rest. But once again, work with your accountant to make sure that
Yes,
they
and then
bless
you
this.
you mentioned about distributions, which takes me to my next point
Okay.
is, taking distributions in excess of basis. And I don't want to go into all the technical calculations on like what is basis, but your CPA should be keeping track of basis and letting you know, okay, how much can I take out in a given year? So that way you don't take distributions in excess of your basis, then those tax-free distributions become taxable subject to capital gain. So I think that's another area that you really need to be
Okay.
mindful and watch out for.
Great.
Um,
And do you have
mhm.
any other common tax problems?
Yes, the 2% shareholder health insurance not reported correctly on W-2 wages. Oftentimes the S corp will pay for the doctor's health insurance, but that income is not being reported as wages on their W-2. So, that's very common. I mean, oftentimes I have a new client and I don't see that on there. So just make sure that your CPA is probably reporting shareholder health insurance.
Oh, that's a good point.
Mhm.
Any
The
others?
next yeah, the next one is, commingling personal and business
Oh,
expenses. I mean, it's a classic. So for meals, just make sure you have the who, what, when, where, and business purpose. Take a snapshot of your receipts, upload it to your accounting software, have a mileage log. There's many, many apps out there that you can keep track. But I think, just keeping, you know, good documentation and making sure you're not commingling personal and business expenses.
well, one of the things we recommend is that you have a separate account that you write all your business expenses out of and a separate credit card. So you only use those for
Yes,
business and then
yes,
you keep it entirely separate from your personal. And then it makes things a lot easier than having to go back at the end of the year and sort through every single transaction.
absolutely, absolutely. The last one is, shareholder loans. Oftentimes, when you take those excess distributions, we reclassify some of those distributions as shareholder loans. So just make sure that it's an arm's length, you're charging interest, paying back in the appropriate, have a quick, simple promissory note, um, just to keep things, arm's length. And the last but not least, partners who are part of a, medical or dental group. If you're a partner and receiving a K-1, you cannot be on payroll. That's also a big no-no. You will receive guaranteed payments, which get reported on your K-1s, but you cannot be a W-2 employee of that partnership.
Awesome. Well, I can see it's important to have the right kind of CPA to help guide you through these quagmires because the last thing anybody wants is an IRS audit. All right. Next question. I found a few of our doctors, beloved though they are procrastinators. So do we, when you've got those doctors that just can't seem to get their taxes done or done on time, do you have any suggestions for them to make it easier?
Yeah, well, honestly, Catherine, I think the best strategy is having the right CPA or advisor who politely, persistently bugs you, like me. So, I just think that doctors, we get it. Doctors are busy. I mean, the goal is to make sure that we have that relationship to where I can keep them on track and make it easier for them to finish than to procrastinate, right? So that means streamlining the process, setting up a secure portal, setting automatic reminders, just helping them, stay on task and stay organized. Because I do strongly believe that they want to get things done, but they're very, very busy. And so I think just having someone, keeping them on track and stay on top of things uh, will come a long way. I mean, I
That,
find that strategy to work to where, what, let me just upload these so Vivian can go away,
yes,
and
I
I won't
love
hear
that.
from her anymore.
It's
Uh,
the whole accountability. It's like having a personal trainer or coach that you got to report to. So I think that's really important.
mhm.
Any other thoughts on that before I go to something that a lot of our doctors are worried about, the big, beautiful bill and hot tax issues? Anything else on the procrastination side before we go on to the big, beautiful bill?
No, I mean, I honestly think, for myself, I schedule quarterly meetings and just, keep sending reminders and, like right now, I'm already sending out client request lists. Do you have any suggestions? I mean, I know that your firm is, you know, actually you really helped me stay on top to do this podcast. So I really appreciate that. And you're kind of like my mentor, like Vivian, like we have to do this, we so I mean, honestly, I think that that's really important is to, have not only self accountability, but someone who helps you, keeping you on track and
I
staying
love that.
focused.
I love it. Thank you. Well, there's a couple things that we do personally. So in our business, in MD Financial, my husband and I actually own more than one business, and we've got some other complexities. But in MD Financial, we literally meet every week to look at the financial pieces. What's the revenue? What are the expenses? And we have projections for this year and into next year. So there really aren't a lot of surprises for us. And then we use this spreadsheet with our CPA. And I meet with him really a couple times throughout the year, but the most important meeting is the one late in the end of the year, where he really pulls everything together for me and kind of gives me a rough estimate of what kind of check I'm going to be writing. And my goal is to make that check fairly small, not just from reducing taxes, but from the surprise. So we'll meet towards the end of the year and he'll kind of rough out what he thinks the corporation taxes will be, what the business taxes will be. And I will tell you, it's a huge stress reliever because one thing that upsets clients is surprises, and nobody wants a tax surprise. So I just say plan ahead. So if you're a doctor who has your own practice, or maybe you've got some sort of side gig, and you're getting up there, maybe you're making $50, $100,000 a year. I think you might engage Vivian or somebody like her to create that kind of spreadsheet for you so you can really see monthly where are you at, or weekly if you want, where are you at and how things are going. So that would be my suggestion, forecasting.
Yeah, absolutely. I completely agree with that. That's why in December, I try to meet with all of my clients, send out emails, and most of them responded, but not all. So, you know, I mean, I
Good.
did my part. So I just think
Yeah,
that, like you said, you're very engaging with your CPA. And I think in order for the relationship to work, I think the engagement needs to be present on both ends.
right.
You do your homework, I do my homework, and then we get together and we compare notes.
All right, on to the hot tax issues and the big, beautiful bill. So what do doctors need to know about that?
Okay, well, I mean, the first big one is if you're upgrading your operatories, buying imaging equipment, replacing computers, investing in practice software, or even doing a remodeling or a build out, 100% bonus depreciation is back. That means that many qualifying purchases can potentially be written off much faster, sometimes immediately rather than, spread out over many years. And when you combine that with Section 179 expensing, it can make a big difference in the year you buy your equipment. So, Catherine, I think the key is don't wait until December and do a panic buy, right? Just for the
Right.
tax write-offs. If you're planning a major purchase, time it intentionally is part of the strategy. It's you don't want to buy an equipment just for the tax write-off. So that's what I'm
Right.
saying. It has to make economic financial sense as well. Um,
Let me
the,
just comment about that because I have
sure.
had some doctors who didn't have maybe as ethical financial, I'm sorry, accountants as you, and telling them, oh, it's getting the end of the year, you need to use this stuff up, go buy a new car. Well, they didn't need a new car.
I hear that a lot too. Yeah, and car is a depreciable asset. It
Right.
doesn't really bring you, I mean, when you invest in an equipment, it generates revenue, right?
Right.
There's an ROI on that. A car gets you from point A to point B, but it doesn't really, it's a depreciable asset,
I totally
which
agree with
works
you.
for taxes, but from an economic
Right.
value, yeah.
Yeah.
So I
You want
completely agree with you.
totally you want to invest in either equipment or other investments like maybe a brokerage account. You won't get the tax benefit, but you're going to have an asset that's going to grow over time. So I'm totally to your point. Be careful if your accountant is telling you just to buy stuff to for tax purposes because it may
Yeah,
not.
or you go buy a luxury car and those has all kinds of limitations. So you're not even getting a full write-off. And there's a business personal use aspect to that. So yes, auto, I would never recommend, my clients to go buy an auto. They would tell me though, and I was like, well, are you sure about that? um, the second is, innovation inside medical practice that we often don't think of. So when most people think of R&D, they think of Silicon Valley, right, or startups. But in healthcare, it can show up in clinical research, improving internal systems, building software tools, or working on a medical device idea on the side. So the takeaway is, not everyone will qualify, but at least if you smell something like innovation, just let your CPA know early, right? Because some of those expenses can really, I mean, let them determine if they qualify for R&D or not, the R&D credit. And that could be, something very beneficial for you to reduce your tax liability.
And I'd say also ask them, are you better off purchasing it outright? Are you better buying it on time? Are you better off leasing? Those are all can all have different tax consequences depending on the years and stuff.
Yes. Well,
Awesome.
you do know a lot of your tax stuff, Catherine. That's
Well,
really good.
I know, shocking after
Yeah,
all these
yeah.
years.
Okay, so the third item on my list is the state taxes, and there's a temporary relief. The state and local tax cap is now up 40,000 from 10,000. However, I'm pretty sure most of your clients fall in this 500 phase out category, so you just have to be very careful about that. But there is a workaround, right? The pass through entity election, tax election, which can be very beneficial for practice owners who are set up as partnerships or S corps. So, in a nutshell, what the PTE election is, it's basically the business elects to pay the taxes, the state income tax at the entity level instead. Because the business pays the taxes, is treated as a deductible business expense. So, which reduces the income that flows through to the S corp shareholders or partners. So, and then you can take a credit, kind of like think of it as a prepayment of taxes or withholdings to offset your state income tax, right? So even though you're not getting even though you're getting phased out and not benefiting from the state tax deduction, you can indirectly benefit at the entity level if you have ownership. So that's a workaround, but every state has a different state specific rules surrounding this, and not all states adopt this PTE elections. So it's always consult your CPA to make sure that the jurisdiction that you're in allows for this workaround.
Oh, good. Good to know. Anything
Mhm.
else of the hot tax issues?
Yes, the charitable giving is also a big, now there's a point four, I'm sorry, 0.5% of the AGI floor.
Right,
So, which means that if you're making these little donations, those won't matter anymore, right? So,
right.
I would aggregate and make sure that you make a big charitable donation in one particular year. Um, and then, I
But
don't
hang on,
know
let
if,
me, if you can't, just a sec, let's go into that in a little
sure.
more detail. So what you're saying is those charitable deductions that are above, it's a 0.5%, I'm assuming it's your adjusted gross income,
Yes,
right? Only those above that 0.5% can you deduct going forward. So one of the things we were recommending to clients towards the end of last year was if they were planning some big charitable deductions in 2026 to make them in 2025 because they obviously could have more of that would be deductible. But I love your idea of bunching them, and how that might work is maybe you're planning some large charitable deductions in 2027, but if you move those into 2026, they might be there. You're going to be able to probably deduct more.
right,
What
exceed the floor.
exceed
Right.
the
So if
floor?
you like, so if you're going to like Goodwill, Salvation Army, or if you donate to your church and they spread it over 3 years, the aggregate sum of those charitable donations might not exceed 0.5% of your AGI
Right.
because you're in such a high income, threshold that those won't matter. So you're just losing those donations. So I just think, the planning and being strategic about it. And, the donor advice fund, I don't know if you're familiar with
Of
that,
course,
but
we do that all the time for doctors.
yeah, yeah. So that's a great way to give away appreciated stocks. And you don't have to pay capital gains. So I think that's one thing that, I would love to work with financial advisors and making sure that, clients are taking advantage of that. The Trump savings account will start around July 4th of this year. So more guidance coming on that. But if you're a practice owner, you can look into creating some type of employee benefit plan and take a deduction. That would probably help to retain clients or even, sorry, not clients, attract prospective employees and take a business deduction. So I think that's a big one. And I think those are the big, hot topics that I think are pretty beneficial.
Awesome. Good to know. And moving on, last thing, what are three things doctors can do now that either can reduce their taxes or maybe optimize their taxes in 2026?
Yes, like I mentioned, just if you're a practice owner, you map out big decisions early. Equipment purchases, technology updates, building timeout, and state tax strategy. Take advantage of the 100 bonus depreciation. I really think that planning opportunity is really about timing and execution and not last minute scrambling.
Right.
Number two, this is simple but really, really important. And you mentioned this too as well, Catherine. Keep up with your books, right? I do think that clean books and up to date bookkeeping gives you a real financial snapshot. So that way we can project your income, avoid surprises, make smarter payroll and distribution decisions. And I think it's also very healthy that you know how your practice is doing. So I think clean books are the foundation for everything. So just make sure that you're keeping up with that. Or if you have an accountant or bookkeeper, make sure that when they send you the financials, you actually look at them and not just, filing them and be done, right? And the last but not least is, retirement planning. Um, I know that maxing out your 401k, if you are a solo practitioner, look into the solo 401ks with in-plan Roth conversions. I mean, this is probably your expertise right here, Catherine. But a lot of my clients are in a very high income, so they're pretty much phased out for all the tax credits,
Right.
and so we're more like our main tax strategy and planning is around surrounding retirements. And I think that's where the collaboration between CPAs and financial advisors are very important for retirement planning. right? I have a lot of clients who has a lot of excess cash, so we look into, a defined benefit plan, um, a more higher power options for them than just the solo 401ks. I do like SEP IRAs because they're simple, they're quick to set up,
Right. And
very,
cheap.
minimal administrative burden. But again, those are limited to your W-2 wages, right? So if we're maximizing retirement, SEP IRAs might not always be the best tool. Do you work a lot with mega Roth conversions?
Yes, we do. And we have some software that can take a client's rough tax situation, and then we can look at how much conversions can we do this year without getting them up into the next tax bracket. And that's the kind of thing we like to do for clients. We do model it out on our software to see if it makes sense. Um, I like to do that in conjunction with a CPA so that they bless it and make sure that because we're not tax preparers, we do big picture tax advice, and I want to make sure that it really fits with clients. I can think about a case I have with a lovely, wonderful client, and she's like maybe 72 and kind of the top earnings of her career, and she has no money in the tax-free bucket. She had no Roths at work, no Roth IRAs. And it made no sense to me to do any conversions for her because she's already in a really high tax bracket and she's going to be retired in a couple years. So very often we'll wait till they're retired, and often they're retired in a number of years before they have required minimum distributions. So that their income is really down during that time period, and that's when we might do a lot of Roth conversions. And more clients are getting mega backdoor Roth options at work, and so obviously you want to take advantage of those too.
Yes, those are great. Those are very powerful retirement vehicles.
And the other thing I think you mentioned, and why I really like working with you, is I think most accountants have very much a backward view. This is what you did this last year. Let's figure out how we can get your taxes as low as possible. It's after the fact, though. You've already pulled the trigger on that. My viewpoint is how do we look in the future? And how do we not only reduce taxes in the next year, but also in retirement? And this is a place where most clients have not considered. Our clients think they're going to be in a lower tax bracket in retirement. Well, maybe, but a lot of them are going to be in the same tax bracket because they have such wealth, their income, and they want the same income. And so it's a shock to them to realize, oh my gosh, well, look at what my tax bite is. Well, if we start early, we can start getting more money in that tax-free bucket, and that really helps reduce their taxes in retirement. It's a very difficult strategy for me to do if you're 70 and you're retiring at 72. But if you're a 35 or 40-year-old doctor, then I've got years and years and years that we can put this in place and really have a huge impact.
Yeah, no, I completely agree with you, Catherine. I have a few, physicians who are now retired and, they live comfortably. And the reason why is because they plan ahead in their 30s and 40s and putting in as much in retirements as possible. So now, playing golf and just living the life, right? And retired at 62, 63, or whenever they want. I mean, they could have retired early.
Right.
So I mean the art of compounding and yeah, I mean it's a powerful strategy. And I think that myself as a CPA alone cannot do that, right? Like I can only help you save on your taxes so you can use those tax saving dollars to contribute into, put towards your
Right.
retirement plans, and let the compounding, works itself.
I love that. So it sounds like you're willing to work with a doctor's financial advisor too, to make sure that they get everything coordinated.
Of course, of course. I mean, I talk about the solo 401k, the mega backdoor and all of that. And I mean, I know the logistics and how they work and the tax implications, but the execution, that's not what I mean, and I don't want to venture, right? I want to stay in my realm and refer to a professional, an expert like yourself and your firm and your team. But yeah, I mean, the execution is very important, right?
Right.
And you also mentioned that you have all these softwares and modeling that can map it out. But again, you also need to work with a CPA who has more knowledge of the tax situation that your clients are in. So, oftentimes, like in the past, I didn't really get introduced to the financial advisor
Mm.
And the client would think, oh, I mean, I'm below the Roth threshold. I can make a contribution. And then when it comes to tax time, no, you exceeded your contribution. So we're over here trying to take the excess out so they're not subject to the excise tax. And so I think that, just having that communication and making sure, like just a quick check in, so that way we're not having to unwind things. And
Right.
sometimes when you unwind and reverse, it can be costly to the clients, right? And that's not really good client service.
And costly and with penalties, tax penalties, nobody
Mhm.
wants. I will say, I think preparing in advance, as we talked about, just for lower taxes and retirement is really important. But also, it's more important every year in retirement that you think through where are we going to pull our money out this year? Are we going to pull it out of the brokerage accounts? Are we going to pull it out of the retirement accounts? Do we have, RMDs? Do we pull it out of our tax-free, the Roth accounts? Each of those has different tax consequences, and it's not so obvious on where to pull the money out. And once again, our software is very sophisticated. It can actually show, well, what if we take your living expenses this year all out of your brokerage account? What does that do to your assets over the long run? And I think those are very important decisions. You have to look at them every year because the tax laws change, the stock market changes, everything's out there, and you really need somebody who can help you plan for that.
Yeah. And one last thing is the estimated tax payments. I try my best to give my clients at least, you know, 15 to a month advance notice because I mean they don't have liquid cash sitting in their bank account, right? You mentioned about having a separate tax account, but a lot of them, they have to write a large tax bill. And so we don't want that money just sitting there idle. So giving them that advance notice will help the financial advisors, liquidate some stocks and making sure that they have enough funds to pay, Uncle Sam. And then also, just I just think that with anything, last minute is never a good thing.
Right. I would
So
say the truer words were never spoken, particularly when it comes to taxes. So, Vivian,
yes,
thank you for being with us today. And you've donated your time so that our doctors can get this great information. I'm really, really grateful to you. So, thank you for being so generous. And for those of you who are listening, please follow us on social media. And I'm really hoping this was very helpful. And if it is, please pass it on to your colleagues. Now, Vivian, how can people get a hold of you, our doctors, if they've got some questions for you?
my website, they can send an inquiry, or I can share my email address, and
So
they can just
let's give them
yeah.
the address for your website and then go, if you can speak it now, that would be great.
Yes, it's PIP. When I came up with the name, I didn't think about the performance improvement plans, but it's really personalized, innovative, and being proactive. PIP tax and consulting.com.
Okay, PIP tax and consulting.com. And then if they want to send an email to you, Vivian, how can they do that?
At Vivian at piptaxandconsulting.com.
Awesome. Awesome. So once again, to our listeners, please reach out to us for questions or topics that you might think would be good in a future podcast. And finally, you can reach out to us directly if you've got any questions for us and my team at info@mdfinancialadvisors.com. So in closing, remember, only you can take care of you. So plan, protect, and prosper.
MD Financial Advisors is not affiliated with and does not receive compensation from PIP Tax and Consulting. Clients are free to select any tax professional. This presentation is not an offer or a solicitation to buy or sell securities. The information contained in this presentation has been compiled from third-party sources and is believed to be reliable. However, its accuracy is not guaranteed and should not be relied upon in any way whatsoever. This presentation may not be construed as investment, tax, or legal advice and does not give investment recommendations. Any opinion included in this report constitutes our judgment as of the date of this report and is subject to change without notice. Additional information, including management fees and expenses, is provided on our Form ADV Part 2, available upon request, or at the SEC's Investment Advisor Public Disclosure website. Past performance is not a guarantee of future results.